moving on. We are going to switch gears to macro, and for an outlook on US inflation, China, treasury markets, oil and gold and much more, I'm pleased to welcome a new guest, Mazen Salhab, Chief Market Strategist at BD Swiss for Middle East and North America region. Good afternoon. Thank you so much for joining us.
Thank you very much for having me today. Good morning from Dubai.
Indeed, from Dubai. So, where would we like to start? There's a lot to cover there, but a lot of it might link back to the US Treasury markets and what's going on there at the moment.
Right.
Yeah, so maybe you can just give us some idea, Mazen, what are you expecting out of the Fed going forward, and have US, let's say, 10-year yields kind of peaked at this point in time?
I think so. We are almost at the peak, simply because we think that the cycle of the rate hike by the Federal Reserve will end very soon. I think the Fed is unlikely to keep raising the rates in 2023, and the market price in more cut, or at least stable rate in 2024, and the cut is not going to happen very soon in 2024. So we think that the yields on 10 years at 4% right now, or 3.9, is unlikely to go higher further. And the gains in the yields in the last 2 weeks actually were because of the bond dynamic, not because that there's a kind of a growth expectation or better outlook. We don't think so. We think it's because of the dynamics in the market, and because the Fed Reserve, as you may know, the Treasury Department keeps selling the bonds right now with $100 billion bond every month. So it's unlikely to gain more or to go higher from this level, considering the macro right now, and considering that the inflation in America is falling. So yes, it's still sticky, but it's falling. So we think that from this level, we can start building positions actually for the mid to long term perspective.
Oh, that's interesting. So are you anticipating, I know everybody loves to focus on the monthly read of the US CPI, and we obviously have that reading coming up, in the next 24 hours. Well, actually much less than that here in Australia, but actually around the world. Do you think that even this prospect that the market's talking about, a so-called avoiding a recession in the US and a soft landing, which would be probably highly unusual when it comes to the economic cycle, do you think that's even feasible, or do you think a recession will come to the US in 2024?
Considering the current macroeconomics in America, we don't think that the recession is going to happen. Soft landing is the most probable scenario right now. But we have to realize the fact that recession is not going to happen in 1 or 2 or 3 months. It takes time. So let's say, like, history is telling us that recession happens or crisis happens not immediately. It took months to realize the weakness in the economy. So right now in 2023, I think we are okay. The worst case scenario will be soft landing, which is, I think it may happen in the first quarter of 2024. But right now, we are not worried about the inflation, for example, because it's falling. We are worried about any mistake that may happen in the Fed policy. And if the Fed keeps raising the rates above 5.5 the coming months, this is going to be very challenging. At the same time, we are worried that the value of the assets in America has not really decreased. And we have to realize that falling the asset prices in America was one of the major things, important things that will keep the inflation low. This is not going to happen. So that's why inflation in America is going to stay sticky, and the rates, by the way, will stay longer. So this is a very challenging. So the rates are not going to fall immediately, and we have to, I think, to live longer with this fact. But I don't think we're going to have a recession, at least in 2023, at least right now.
Okay, does that mean the US markets, stock markets, are just really quite overstretched at the moment on a valuation basis?
It is actually mainly in S&P and Nasdaq, where we can see like earnings per share ratio or price earning ratio are so much high right now. It's higher than Europe, UK, and even Japan. So, and it really it is worried if you are trying to building positions right now, because as you may know that in 2023 was up until now was really a very good year in US market, and the second half of this year is unlikely to be similar, simply because the market will start to realize that there's a kind of overbought sentiment in the market. So I think we need more than low inflation. We need more than economic growth perspective for the US market to stay bullish in the second half. Valuations right now matter, because if you don't have any new macroeconomic, if you don't have any change in monetary policy, then valuations matter. And that's why I think the traders and the investors will start focusing on. And then we may start shifting from the US stocks in the last quarter of 2024.
Do you like oil at the moment? It's had quite a good run. There's been, some supply caps. China's obviously a bit of a question mark at the moment, but do you think oil is going to maintain this momentum?
I think there's a big gap right now between the fundamentals and the market. Yes, fundamentally speaking, we should not see oil prices at 84, 85 at the current level. But if you are saying, if we are talking about the market sentiment, I think the market are still pricing in higher level up to $90 for WTI, simply because the clash between OPEC plus countries and America is likely to go on. America wants weaker energy prices simply because of the politics and because of inflation. This is, I think, gonna keep the prices very tight. And this kind of geopolitical tension between OPEC and America, and not to forget what's going on between Ukraine and Russia, I think this is a very important to keep the prices higher right now at 85. We are expecting further gains, but these gains are not going to happen because of the fundamentals.
Indeed. Now, Mazen, just really briefly, gold. Gold, doesn't seem to be going very far at the moment. Typically, you would see it when real yields are coming down. But listening to you, that would make me think possibly you're not particularly upbeat on gold. Is that correct?
I'm not bullish on gold, to be honest, right now, because my worry is that the higher short-term yields, 3 months, 6 months, and 12 months in America remain above 5%. So minus inflation, the real yields are not the best scenario for gold right now. In the long term, yes, should be like 20% of your portfolio should be in gold. But in the short term, I still price is going to stay under pressure. And we are not surprised to see 1,900 or even 1,880 again in the coming weeks.